Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
And welcome back to Retirement Unlocked with Larry Heller. Many retirees assume that Medicare costs are standard across the board, but for higher income retirees, that's not the case. Your premiums for Medicare Part B and Part D can increase significantly due to something called IRMAA, Income-Related Monthly Adjustment Amounts. Today, Larry discusses how these increases are based on income from your 2 years prior, meaning the decisions you made in the past could be costing you today, and how, without proper planning, retirees can unknowingly trigger higher premiums year after year. Larry, first, it's great to see you. How are you, my friend?
I'm doing great, Bill. How are you?
I'm doing fantastic. It's a gorgeous, beautiful, beautiful day as we record this. The sun is out. I feel great. And IRMAA reminds me of like a girlfriend I might have dated once, but I think she was a lot nicer than the IRMAA we're going to talk about today.
I hope so.
Holy smoke. Let's start with, because a lot of people do not know what IRMAA is, as it affects everybody. You think they would. So let's start with the simple. What is IRMAA?
Like you mentioned. So what is IRMAA stands for? Income Related Monthly Adjustment Amount. Wow. So
a mouthful there, buddy.
There's a mouthful there. So, so when you go on Medicare and you go to pay your Medicare premium, they will charge you a surplus based upon your income. It's an additional surcharge that's added to your Medicare Part B, which is your medical insurance, and your Medicare Part D, which is your prescription drug coverage.
Wow.
And so many people have no idea that this surcharge is coming. And no matter what, we have clients that have a lot of money and earn a lot of money, and they get so annoyed that they have to pay this extra little surcharge. So it applies to different individuals depending upon their income and certain thresholds. So we want to kind of see what we can do about that. Now, we don't want to let IRMAA solely control your planning, your cash flow, your investment decisions, but there are things that you can do to possibly lower your IRMAA.
Oh, I like that idea. But before we get into that, Larry, let's first get into how IRMAA is calculated. How's that set up for us?
Okay. So first, they look at your tax return 2 years prior. So if you're going to go in Medicare, age 65, they're going to look at your income at 63.
Oh.
And they're looking at your wages, what you've withdrawn from your IRA, if you've withdrawn anything, capital gains, rental income, all your income. But they also look at something else, because we've had people say, well, I'll just buy all muni bonds. I won't have any IRMAA. Doesn't work that way. Tax exempt interest is included in your IRMAA calculation as well. So that's how they do that. Looking at if you're 2026, they're going to look at your 2024 income to determine your IRMAA. But here's a tip for you. Okay.
Please.
What? Yes.
Yes. Please give us that tip, Larry.
Okay. So there is a form that you can get called SSA 44 from the Social Security Administration to report a life-changing event. So what is a life-changing event? Retirement, marriage, divorce, death of a spouse. So in 2026, if you're now retired, you can fill this form out and you can now put in what your income is going to be rather than what your income was in 2024. So make sure that you kind of look at that and figure out if it is going to be less, that you file that form to get your IRMAA reduced.
Yeah, God forbid you suffer some sort of tragedy that would make you eligible for this kind of thing. But if you have suffered that tragedy, you should be aware that there is a way that you can use the system to your advantage. But Larry,
it's not even just a tragedy, Bill. It's just if you're retiring and you're stopping working, so now you no longer have any salary. So there's a good chance your income can go down, especially if you're not taking your required minimum distributions from your retirement account yet.
Oh, okay.
Yeah.
So when I was 63, I stopped working.
Okay,
I haven't started taking any income from any of my retirement plans.
Right. So at 65, that would have been 2 years ago. So you would have been okay. But if you had stopped working in 64 and started Medicare in 65, they'd be using your income from when you were 63. So that's when you want to kind of file this form to see, 2 years ago.
Okay. Can you lay this out for us and help us understand these IRMAA brackets? How are they set up and what are the thresholds?
Yeah, so I'm going to just share a screen with you right now to kind of look at the different thresholds here.
Very nice, Larry.
And it depends upon your income. So if when you do start your right now in 2026, your Medicare Part B premium is $202.90. If you're married, it's $218,000 and less. Once you hit $218,001, there's a surcharge. There's $81.20 surcharge for Part B and a $14.50 surcharge for Part D. Now let's jump all the way down, and this is where the numbers start to increase. If you're making more than $500,000 and you're single, or $750 and you're married, now your surcharge is an extra $487 and $91 for Part D. So your total premium is $689 and $91 for Part D plus whatever the Part D premium is going to be. So you can see that can add up. So if it's roughly a $560 increase, you're over a $6,000 higher premium at that income level. And so again, so now they're going to kind of look at this. So if you have 1 year, we'll talk about your differences. So it's a big difference if you're going to have a large income in 1 year rather than spreading it out over 2 or 3 years, which could impact your IRMAA.
Wow. First of all, for those of you who are listening to this podcast right now and you couldn't take, you're driving and you couldn't take a chance to look at the brackets, be assured the chart that Larry just shared is in the show notes, and you can go back and reference that bracket a little later, see the numbers, and get a much clearer idea of where those brackets fall and where you, as a matter of fact, fall in the middle of them. It's funny, Larry, I told you I didn't know about IRMAA until I needed to know about IRMAA, which was, and I was shocked that more people don't know about this, because this can make a massive difference in terms of retirement planning, can it?
Well, I wouldn't say, massive difference, but like I just said, it could be an extra $6,000 a year of premiums that people don't want to pay. They're already paying enough in the Medicare premiums and maybe even additional health care costs. So no one likes to have the surprises when they get their first premium payment and they think it's going to be $202 and it's $689. So
that's a little bit of a difference, Larry.
It's a little bit of difference.
But it's one of those, well, at least, it's triggered by good things.
It is. But again, it's one of those things. If you can plan for it and possibly reduce it, why not? So
how do we do this? I mean, how do we make things better?
Right. So you want to kind of start thinking about things earlier on. Some of your investment decisions, your withdrawal strategies, and your tax planning. And obviously taxes are a big part of this. I kind of look at this as just another tax. So how can you do some of these type things? Because what's going to happen is you may have these lower premiums. And now what's happened is, and this is not just for IRMAA purposes, it's for tax planning purposes, if you're born in 1960 or later, you don't have to start withdrawing from your IRA until you're 75. Even if you're older than that, it's 73. And if you let your IRA grow so high, your required minimum distributions later on not only will kick you into a higher tax bracket, but as we looked at the chart, will kick you into a higher surcharge. So you want to kind of really start doing some planning. Does it make sense to take some money out of your IRA earlier when you're in lower tax brackets? Goes against what a lot of accountants are going to think, but you want to kind of plan not just what your current tax is going to be, but what your future taxes are going to be. So you want to kind of, think ahead about that, because that can trigger a higher IRMAA. A large IRA withdrawal will trigger that. And one of the things that we do when we're doing planning now, we're doing a lot of Roth conversions. Mm-hmm. And I've talked to people and that have done Roth conversions, and after they've done it, the next year, all of a sudden now, 2 years later, they're getting higher IRMAA because they did this Roth conversion, and no one told them that if they did this Roth conversion, although it may be good from tax purposes, it's going to kick them up into a higher IRMAA. Or selling a highly appreciated asset may trigger capital gains, which is going to add to that. So these are common triggers. And again, you don't want to just do things to avoid the IRMAA. You want to make sound financial investment decisions and cash flow planning decisions, but you should know what some of these triggers are. And if you know what some of these triggers are, you can do some planning.
Well, that's just what I was going to ask you. You're talking about the triggers at the moment, but now let's talk about some of the strategies that you can help your clients manage their IRMAA. Okay, talk about some of that.
Yeah. So like I mentioned before, if it's possible, you may want to, not do a large spike in a single year of income. So if you're thinking, and we've actually had some clients and they were doing this and they wanted to reduce some of their exposure in certain things, and they've done it the last day of the year and the first day of the next year. Or if they're getting some income, maybe they had some deferred compensation that they're owed, and instead of taking it all in 1 year, they've taken it over 3 or 4 years. So we have some, doctors that work for some bigger hospitals, and they were able to do some deferred comp, and that's one of the planning that we're thinking about doing. So those are some of the proactive income planning that you could do prior to even retiring. So you start thinking about this later on.
No, it makes a lot of sense. What about Roth conversions? If you're going to convert, is there a better time to do it than others? Because it is going to lead to increased income.
Yeah. So, if you're lucky enough that you're able to retire before 65 and going on Medicare, and you have these years where there's low income and you haven't taken your Social Security. So now you have no Social Security, you're not working, you're retired. Maybe your income is really, really low at that point. You want to fill up some other buckets there. So now you do some Roth conversions and you're lowering your future required minimum distribution. So by doing this Roth conversion, possibly can lower your IRMAA later up. So by filling in some lower tax brackets without triggering the IRMAA later is one of the things that you want to, is helpful when you're doing a Roth conversion. Again, if you're already at 65, it still may make sense to do a Roth conversion, but now you may be receiving Social Security, maybe not, but now you are possibly on Medicare, so it could trigger the IRMAA surplus.
What about RMDs? They're required minimum distribution. Right. So how do you manage a required income, as it were?
Right. So like we talked about a few minutes ago, you may not want to wait until you're 73 or 75. In the old days, you would take your taxable income first, and then you take your qualified money later. Yep. And because that could grow tax deferred for you, and you still may want to do that. So you have to look at all these numbers, and luckily we have all these computer calculations that can help us with this, and to show you what tax bracket you're going to be in, what IRMAA numbers you're going to have. So you may want to do some Roth conversions earlier on. The other thing to think about is when you're at retirement age, RMD age, you may want to do some what's called qualified charitable distributions, QCDs. So instead of taking money out of your IRA, which would be taxable, and maybe you're charity inclined and you're given charitable deductions out of taxable income, you should now possibly do a QCD out of your IRA. What are you doing here? Well, you're giving to the charity, but now you're not recording taxable income because the money's going to the charity, reducing the amount of your required minimum distribution, reducing amount of the income, and therefore could be reducing the amount of the IRMAA surplus.
Yeah. And as I understand it, QCDs cannot. If I'm going to do a QCD, I can't take possession of the money and then give it to a charity.
Correct.
Right. I have to arrange for it to go directly to the charity receiving it. Correct.
Correct. And the other thing also is, again, depending upon where you are, if you do have a large one-time income event in 1 year, you could do what's called a donor advised fund. So, we're going to do a separate podcast. We've done this before on the charity side, but now you can put a large amount as 1 year deduction and spread it out over charities over a year, but you can use this deduction to possibly offset a one-time income. So that's another little strategy there to hopefully minimize the income and minimize taxes and IRMAA surpluses.
What about capital gains? I mean, everybody's got them. If they've got stock portfolios, they're going to have capital gains in there.
Yeah.
How do we manage those?
Again, you don't want to have those decisions, investment decisions, solely from your IRMAA control. But again,
True.
If you can spread that amongst multiple years, that'll help. If you can take some of the gains in years that you may have some deductions to some losses to offset. So there's a little bit of planning that can come involved with that. But so you want to kind of have to look at creating a tax efficient withdrawal strategy. Mm-hmm. So a lot of planning goes into this and how to minimize your taxes when you're retiring, because when you're doing that and knowing which account to withdraw from, your taxable account, your tax-deferred 401k, IRA, or possibly if you had a Roth, which accounts does it make sense to withdraw from to minimize your taxes, and then also helping you out on minimizing your IRMAA surplus.
Great. What about any long-term planning pitfalls that we should be aware of?
Yeah. So again, IRMAA does create these planning windows. Anywhere between age 60 and 65, are really critical years to planning on this. We had a client come in, about a year ago, and he was already in his 70s. And he now is paying IRMAA, and because he's got a large amount of money in his IRA, and we looked at, there was multiple years that he had no income, that he could have been doing Roth conversions, which would really have helped him out on the taxes and also helped him out on bringing down his IRMAA surplus. But it's already too late. So don't miss those opportunities later on when you're already starting to pay some of these costs. Start thinking about it and positioning yourself for more efficient withdrawals later on.
No, it makes total sense. Can you give us some key takeaways from this episode we should be aware of?
Yeah. So, IRMAA is, it is a hidden cost, but it could be controllable depending upon your scenario. Sometimes a small income increase. So if you're looking at this, like I mentioned when I showed you the chart, $1 over is going to kick you into the next bracket. So if you're going to be close, you want to do some type of, planning the year before.
Yeah.
But in addition to that, you want to plan years in advance if possible. So coordinating that, knowing that year by year that it exists, and if you can possibly keep yourself in a little bit lower bracket, that's great. And then coordinating your tax strategy along with your health care, and do it as early as possible, which will give you the most flexibility.
Makes complete sense. Before we get out of here, Larry, are there any real life scenarios that you could share with us that might help people understand it better?
Right. Well, I just told you one of them a few minutes ago, that waiting too long.
Waiting to your 70s too late.
It's too late, and doing late Roth conversion, but not even in your 70s. If you wait until you're over 65 and you're doing these Roth conversions, it could trigger higher taxes and could trigger some supplements to avoid. So, and also the hidden cost of selling a property. Now you can't always control it, but we did have a client that was selling a property, and they were going to be kind of age 62 to age 63, and one of the things that we looked at is, can we close on the deal before the end of the year, for a lot of different reasons, but also for tax purposes, it would help.
Sure.
Would help that. So looking at where you are income wise versus where you're going to be, some of these capital gains. So could significantly increase your Medicare premiums 2 years down the road.
Yeah, it could. I mean, there is an upside to this, I guess, from looking at it from my perspective. If your increased premiums are there, it's because you've had increased income. So if you got to look for a silver lining in anything, maybe that is one place that you should look. But Larry, you're better.
Yeah, you can look at it that way. That you have, but sometimes it may not be. It may be just it was 1 year when you could have spread it out. So it's not like the silver lining is there when you could have spread it out over more years, or you could have reduced your income by doing some of these strategies.
Yep.
So you're still getting the same amount of money, but you reduced your income, therefore reducing your taxes and your IRMAA. So it's not just, I'm making more money, I can pay for it. Yeah, but you could have been making the same money and just paying less in taxes and less in premium supplements.
And thus the value of working with a financial planner such as yourself. Right then and there.
Exactly. So, don't let, final really word is, don't let the increase in IRMAA costs drive all your financial decisions, but be aware of them and how to navigate where possible and be able to still have good financial outcomes and minimize where you can some of these IRMAA surpluses.
Excellent advice. Good advice. Take it to heart. And for those of you listening, if today's episode helped you better understand how IRMAA can impact your Medicare premiums and how proactive planning can help you avoid unnecessary cost, please like, subscribe, and share this podcast with someone you think could benefit. And if you are approaching Medicare age and want to discuss your retirement planning strategy, schedule a complimentary consultation using the link in the description for a 20-minute call. I want to underscore that. Complimentary. It's free. It costs you nothing. Now, please note that Heller Wealth Management is now part of Savant Wealth Management. Savant is a registered investment advisor. This content is provided for informational and educational purposes only and should not be construed as personalized investment advice. Thank you. We'll catch you next time.